Okay, so let's unpack this. Can you really be lazy and smart with your money at the same time? It kind of sounds like a paradox, doesn't it?
Eh,
Today, we're doing a deep dive into insights from, well, two absolute investment giants,
mm.
John C. Bogle and Benjamin Graham. We want to uncover the surprising path they talked about, becoming a lazy genius investor. Low effort strategies, but by high discipline, that can quietly build some serious wealth.
Yeah, and what's really fascinating, I think, is how their core ideas, even though they're from different times, they converge so powerfully.
Hmm.
They end up offering this unified, really effective approach, and it's fundamentally about keeping things simple,
Yeah.
avoiding all that unnecessary complexity. It really leads to, quietly building wealth over the long haul.
Absolutely. So, okay, let's start with the lazy part. That seems to come mostly from Bogle, right? His whole common sense thing with
Correct.
mutual funds.
Right.
His philosophy, it really centers on, well, radical simplicity. He famously said, the secret of investing is there is no secret. That's quite a statement, isn't it? It just cuts through all the noise, all the hype you hear.
It really does.
Tells us that, true financial wisdom, it's often hiding in these straightforward, consistent actions, not some complex scheme. It's about letting time be your friend, letting compound interest do its miracle.
And that leads us straight to the power of index funds, which Bogle really championed.
Yeah.
I mean, think about it. Active managers, they're constantly doing this rapid fire trading, right? They're shuffling through portfolios like short-term speculators, and often, frankly, with very little to show for it.
Well,
A sensible investor, though, they embrace the certainty and the incredibly low costs you get with indexing, just to put some numbers on it. The lowest cost equity index funds, their expense ratios are tiny, like 0.2%.
0.2. Okay.
Compare that to the average active fund charging around 1.5%. Some even go up to 2.2%. Big difference.
Okay, you mentioned those ratios, 0.2 versus 1.5%. I mean, on the surface, that sounds tiny, almost negligible, right? Is that really where this tyranny comes in? Is there more to Bogle's warning? He called it the tyranny of compounding.
That's precisely it. And it's profound, really. Imagine like a tiny, persistent leak in a bucket.
Okay.
Over years, even just a drip, it can empty the whole thing. That's exactly what higher fees do to your long-term returns. They cause this ever-growing compounding drain on your wealth.
Wow.
Bogle showed that over time, a higher cost investment just loses ever more ground to a lower cost investment. And the result, sharply lower capital accumulation.
So it's not just the explicit fees printed on the label then. There are hidden costs too.
Exactly. That's a key point. Active funds, they often rack up these hidden transaction costs, usually around 0.5% to maybe 1%.
Except from buying and selling.
Right, because of their high portfolio turnover. It averages, believe it or not, around 80% annually.
100%.
Yeah, so this makes them really tax inefficient. You, the investor, are forced to pay taxes on gains much more often, whereas index funds, they're inherently tax efficient precisely because their turnover is so low.
Makes sense.
And historically, the data is clear. Low-cost index funds have beaten the overwhelming majority of active funds, both before and after taxes, and importantly, with significantly lower risk.
That's a powerful combo, right? Lazy and effective.
Okay, so we've got the lazy bit down, Bogle, simplicity, low costs. Got it. But the title promises a lazy genius. Where does the genius part come in? I'm guessing Benjamin Graham has something to say about the discipline needed here.
Oh, he certainly does. Graham, often called the father of value investing.
Huh?
He taught that a stock isn't just some ticker symbol bouncing around on a screen. It's actually an ownership interest in an actual business.
That changes how you look at it.
It changes everything,
Yeah.
especially how you react to market volatility.
Yeah.
He famously described the market as this pendulum that forever swings between unsustainable optimism and unjustified pessimism. So basically, Graham's telling us, don't get caught up in the hype, the FOMO, or the panic selling, even when, your neighbor's bragging about some hot stock or the news is screaming recession.
Exactly that.
The real genius is understanding these emotional swings happen, they're part of the market, but you don't have to ride them. That's the discipline part, acting rationally when everyone else isn't.
Precisely. The intelligent investor, as Graham put it, sells to optimists and buys from pessimists. He was very explicit. Don't try to forecast prices, he advised. Never buy a stock immediately after a substantial rise or sell one immediately after a substantial drop. It's about emotional detachment, really.
And practically speaking, for building a portfolio, How did Graham translate that wisdom? Is it just about avoiding bad timing, or did he have a specific lazy genius approach for the average person?
For most people, yeah, he was very clear. Not diversifying is foolish, and his ideal choice. Interestingly, for most investors, it was actually a total stock market index fund.
Which lines up perfectly with Bogle.
Exactly. It's the ultimate low-cost way to basically hold every stock worth owning. Broad diversification, minimal effort. Lazy. Genius.
Okay, but that raises the question again. If it's so simple, buy an index fund, sit tight, ignore the noise. Why does Graham call this approach genius? It almost sounds, well, too easy.
Well, because true wisdom often is simple, but simple doesn't mean easy to actually do without discipline. Graham believed that the more elaborate and abstruse the mathematics, the more uncertain and speculative are the conclusions.
Interesting.
He argued that real investment genius isn't about chasing some fleeting projection, trying to predict the unpredictable market. It's about protection.
Protection.
Protection from the common mistakes, overpaying for assets, getting overconfident. It's having the insight to see what actually matters for long-term wealth. And often that's much less complicated than the financial industry wants you to believe.
Right. So wrapping this up, what does this all mean for you listening right now?
Well, the lazy genius investor, it seems, embraces simplicity. They prioritize low costs, they insist on broad diversification, and maybe most importantly, they maintain that long-term discipline. It means understanding that patience and just keeping expenses down often beats that frantic chase for market-beating returns.
Yeah, and if we step back to look at the bigger picture, the consistent message from both Bogle and Graham, these titans, is that genuine investment genius often means doing less, actually, but doing it intelligently, consistently.
Yeah.
So maybe a final provocative thought for you to chew on. If this path to long-term wealth really is so straightforward, why do so many investors keep making it so complicated?